Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, let me introduce myself. I'm Naurah Atika Dina. I'm a student from Accounting Department, Andalas University 2017. On this occasion, I would like to present you about my thesis presentation. The title is The Influence of Corporate Risk and Inventory Intensity on Tax Avoidance Pre and Post of COVID-19 Pandemic was confirmed in Indonesia. Study case on consumer goods sector companies listed on the Indonesian Stock Exchange 2 quarters before and after the confirmation of COVID-19. Before I will start my presentation, first of all, I would like to say thank you so much for my thesis advisor, Sir Dr. Fauzan Misra, S.A. M.Sc. AKCA BKP, who have guided me, gave new insight and motivation so that this thesis can be completed. And also for my thesis reviewer, who will give comment and suggestion to build this thesis to be even better. Thank you so much for the audience who watched this video. I hope you can enjoy this presentation. So let me show you the contents of this study. First, introduction. This section consists of background, problem statement, research objective, and also research contribution. And the second, literature review. This section consists of theoretical framework, previous study, conceptual framework, and also research hypothesis. And the third is research methodology. This section consists of research design, population and sample, research variable, data collecting technique, and also data analysis technique. And the fourth is result and discussion. This section consists of research object, data analysis, and also discussion. And the last is conclusion and suggestion. This section consists of conclusion, implication, limitation, and also future research. Okay, we move to the first chapter is introduction. 1. Background. We already know tax is one of the sources of funding for the state. Through tax paid by the community, the government will also return the benefit to the community in another form through the implementation of state programs for the welfare of all people. Tax revenue continues to increase from year to year. Based on the data from the state budget or APBN, tax revenue has increased every year, and it is estimated that the 2020 state budget will increase by 1,865.7 billion. However, it is different from the reality in 2020 this year. At the beginning of 2020, a case of virus outbreak had hit the Wuhan area in China, which can be called coronavirus. Coronavirus is a virus that attacks the respiratory system and can cause a minor disturbance to the respiratory system, several lung infection, and even death. On March 2, 2020, President Joko Widodo announced the first 2 positive cases of the coronavirus in Indonesia. In this highly connected and integrated world, the coronavirus outbreak will not only disrupt China's economy but will also spread globally. After the COVID-19 was confirmed in Indonesia on March 2, 2020, the world's economic condition, including in Indonesia, was slump. For Indonesia itself, Sri Mulyani, as the Minister of Finance of the Republic Indonesia, said that this had never happened and would be a breakthrough to prevent countries that previously had no problems experiencing risk from the foreign exchange and also liquidity side. Based on the statement of Sri Mulyani, the impact of the spread of COVID-19 on the Indonesia economy will be more complex and exceed the crisis that occurred in 1998 and also 2008 until 2009. In the business record, economic performance up to the third quarter of 2020 still experienced a contraction due to the slow process of national economic recovery. Trend in economic performance is also in line with a contraction in tax revenue, which until September 2020 is approaching 17%. The main sector of tax revenue, such as manufacturing, trade, and construction or real estate, experienced a significant decline in performance. Minister of Finance Sri Mulyani has repeatedly revealed the risk of the performance of tax revenue in 2020, which has the potential to miss the outlook for the 2020 state budget. This is due to the depressed condition of corporation and society due to the pandemic. Meanwhile, tax revenue until September 2020 reached 750.62 trillion or 62.61% of tax revenue 2020 from tax revenue target 1,198.8 trillion. This means that until the end of the year, the government must pursue a tax revenue target of 448.8 trillion or every month 149.39 trillion. Therefore, the government has officially reduced the corporate income tax rate to 22% in 2020 and also 2021 and to 20% starting in 2022. This is because this year's taxpayer experienced a decrease in turnover due to the COVID pandemic. The amount of income tax owed also decreased. Even though the government has lowered the corporate income tax rate, the tax is still a mandatory contribution to the country, which become indebted to compel individual or entities. The company's objective turned out to be at odds with the government goal and of maximizing revenue from the tax sector. The existence of different views between government and also company management regarding the causes of taxation of many companies encourage management to handle it in various ways, one of which is by manipulating company profit. Therefore, many companies carry out tax planning to minimize current and future tax burdens such as tax avoidance. Tax avoidance is an activity carried out without violating the taxation law in force in a country, meaning that it is a legal and safe activity for a taxpayer due to activity. This is done by taking advantage of the weaknesses contained in the tax law and regulation. This activity is carried out to reduce the amount of corporate tax to increase company profit and will have an impact on company value as seen from the stock market price. So by enabling tax avoidance, many companies are taking advantage of this loophole to reduce the deferred burden on the individual or corporate taxpayer. On the other hand, tax avoidance activity can cause losses to the state if this activity leads to tax avoidance action that are too aggressive, thus reducing tax revenue regarding COVID-19 in this current condition. Even though the government has lowered the corporate income tax rate, it doesn't mean that all taxpayers will obey and report tax accordingly. There is still a possibility for taxpayers to do tax avoidance due to current weak economic condition. As a result, at this time, many companies went bankrupt or downsized, so that many employees were laid off. Meanwhile, for other companies that are in the midst of this pandemic, there are still companies that are in good health, then some are in a liquid financial condition but are not profitable, and some are in the unhealthy condition and have no profit. So the company's current focus is first to regulate cash flow by restructuring credit, and secondly to reduce financial burdens that are not urgent, can be postponed or corrected, such as delay in payment of all taxes, levies and other fees. In this study, wanted to know the effect of corporate risk and inventory intensity on tax avoidance for 2 quarters before and after the confirmation of COVID-19, and wanted to test whether there are differences in the companies that avoided taxation in the period before COVID-19 and after COVID-19 is currently confirmed. This study takes the independent corporate risk variable because company risk is a reflection of the policies taken by the company. In current condition, executives who dare to take risks will be very likely to do tax avoidance to save the condition of their company. And for inventory intensity is one form of investment owned by company. On the other hand, a company must take various risks when investing in inventory. One of risks the company might face is a damaged inventory, which means a loss for the company. Likewise, the large amount of inventory intensity is expected to change tax avoidance. Because there is still a little research on the influence of several independent variables on tax avoidance, with a comparison of two different times due to the impact of events globally, this research is one of the few studies that discuss the influence of several independent variables on tax avoidance in the time series 2 quarters before and after the confirmation of COVID-19. Previous studies have not used this time series in tax avoidance category. Meanwhile, this research was conducted to determine and examine the effect of several independent variables. There are company risk and also inventory intensity on tax avoidance with a sample of consumer good industry sector companies listed on the Indonesia Stock Exchange. Researchers choose consumer goods industry sector companies because their sales tend to always increase. However, the company's output is needed to people's daily consumption. For year to year, there have been development in line with the high needs and demands for the community. Thus, it can be assumed that the company will place more emphasis on paying tax through tax avoidance. The main problem formulation of this study are: first, how will corporate risk affect tax avoidance pre and post of COVID-19 pandemic was confirmed in Indonesia, and second, how will inventory intensity affect tax avoidance pre and post of COVID-19 pandemic was confirmed in Indonesia, and the last is how is the differences between tax avoidance pre and post of COVID-19 pandemic was confirmed in Indonesia. And for research objective, first is to find out how the influence of corporate risk on tax avoidance before and after the confirmation of COVID-19 pandemic was confirmed in Indonesia, and the second is to find out how the effect of inventory intensity on tax avoidance before and after the COVID-19 pandemic was confirmed in Indonesia. And the last is to find out how the difference between tax avoidance before and after the COVID-19 pandemic was confirmed in Indonesia. This research is expected to provide benefit and contribution for the future and also interested parties. First, with theoretical. This research is expected to add and develop insight, information as well as a framework of thought and can be used as a reference to further studies related to tax avoidance, the differences between before and after the confirmation of COVID-19, so that it can provide a new theory on the current phenomenon regarding the stage of the company in carrying out its specific tax obligation against tax avoidance in the period 2 quarters before and after the confirmation of COVID-19. Besides that, this research is expected to provide academic insight for all students as additional knowledge, input, and reading source as well as new information regarding the field of taxation. And the second, empirical. This study uses a measurement method with two independent variables, corporate risk and also inventory intensity, in which this variable cannot be estimated whether they affect tax avoidance or not, and also increase the generalization of research through sampling procedures in the consumer goods company sector industry on the IDX with a range of research before and after the confirmation of COVID-19 in Indonesia. And the last is practical. This research is expected to provide new information for tax policymakers about the factors that influence tax avoidance action by the companies so that they can strengthen tax regulation and also the loopholes for tax avoidance can be suppressed. Besides that, it can also be used by taxpayers in tax planning. Chapter 2. Literature Review. First, agency theory. Agency theory was first coined by Jensen and McLean at 1976 to define the differences of interest between principal and agents. Therefore, related to this research, agency theory is the transfer of responsibility given by shareholder to management to make decisions. Management is a party contracted by shareholder for the company research and is accountable for the task assigned. Managers prioritize their interests and internal company parties such as salary increase and also bonus, while shareholders prioritize their interest to improve their profit. The difference in reporting between commercial profit and taxable profit can create a conflict of interest for manager in reporting company activity. Principal will oversee and monitor by incurring costs to agent so they don't commit irregularities. And second, tax understanding. Based on KUP Law number 28, the year of 2007, Article 1, Paragraph 1, the definition of tax is mandatory contribution to state that is owned by an individual or fascinating entity based on the law without receiving direct compensation and is used for state needs for the greatest welfare of the people. Tax management is a management strategy to control, plan, and organize aspects of taxation from the side that can be benefit the company's business value by extending to carry out taxation obligation following laws and regulation. So with tax planning that is supported by clear tax management concept, it is expected to optimize the level of company-like liquidity. And tax planning is a systematic analysis of different tax options aimed at the minimization of tax liability in current and future tax periods, whereas tax planning is a systematic analysis of different tax options aimed at minimizing current and future tax liability, and also a process of organizing the taxpayer business so that the tax payable at the minimum but remains in the corridor allowed in the statutory regulation. In tax planning, there are three ways that taxpayer can do to reduce the amount of their tax burden. There are tax saving, tax avoidance, and also tax evasion. In this study, more focused on tax avoidance. Tax avoidance is a scheme that handles the tax burden by exploiting the gap of country's taxation provision so that tax experts are responsible because they don't violate tax regulation. And corporate risk is a reflection of the policies taken by the company. The policies taken by the company leadership can determine whether the leadership has a risk-taker or risk-averse character. A company leader or executive is an executive risk-taker who dares to make business or management decisions. Meanwhile, executives who are risk-averse to executives don't dare to make business decisions. Companies with high corporate risk or risk-taker tend to avoid tax. And for inventory intensity is a method used to measure how much a company invests in inventory. Companies that have high inventory intensity usually have high effective tax rate. This is because company that invests in inventory cannot do the same thing when the company has high capital intensity, which means in terms of depreciation, which can be used as a deduction from taxable income. And the last is coronavirus disease 2019 is an infection disease caused by serious acute respiratory syndrome coronavirus 2. It was first identified in December 2019 in Wuhan, Hubei, China, and has appeared in ongoing pandemic after the coronavirus was confirmed in Indonesia on 2 March 2020. The world economic condition, including in Indonesia, has become down. For Indonesia itself, Sri Mulyani, as Minister of Finance, said that this was something that had never happened and would be breakthrough to prohibit countries that had previously experienced no problem for experiencing risk from the foreign exchange and liquidity side. Previous study, first by Darren, have the title The Effect of Executive on Corporate Tax Avoidance. The result in his study is the executive has a significant role in tax avoidance, and also supported by the research from Dewi and Jati 2014 and also Rizky and Puspitasari at 2020 and also Darren et al. At 2010 and Zwesti at 2016 and also Putri 2018. They found that the companies with high-risk companies or risk-taker tend to avoid tax. Executives who have a risk-taking nature will be not afraid when making high-risk decisions. The more daring to take risks, the higher the executive action in tax avoidance. But contrary to research conducted by Chesbiandani et al. At 2019 and Oktamawati 2017, they found that corporate risk has no significant effect on the tax avoidance because the not only corporate risk that will affect tax avoidance. And research conducted by Muzaki at 2015 and Lazar 2014 found that companies have high inventory intensity usually have high effective tax rate because company that invest in inventory cannot do the same thing when the company from high capital intensity, meaning that depreciation can be used as a deduction for taxable income. But the results of the study are inversely proportional to the research conducted by Anidika et al. At 2018 and also Artinasari and Mildawati 2018. They found that inventory intensity has no significant effect on tax avoidance. They stated that tax avoidance didn't depend on the inventory intensity on the company. The results of previous research that are relevant in this study are used to help get an idea and in the preparation of framework for thinking about this research. In addition, previous research can develop the insight and ideas of this study to get new results because the study is different from previous research, where in the study a comparison of global phenomenon pre and post of COVID-19 was confirmed. Based on the theoretical framework and strengthened by previous study, result on the relationship between independent variable inventory intensity and also corporate risk and dependent variable is tax avoidance, then the following is presented. A conceptual framework of this research is conducted by this framework. So in the right side is independent variable and on the left side is dependent variable, and it has A and B hypothesis, and also the hypothesis 3 is different tests. Research hypothesis. This study consists of several hypotheses. First is hypothesis 1A. Corporate risk has a positive effect on tax avoidance. Pre-COVID-19 pandemic was confirmed in Indonesia. And second is hypothesis 1B. Corporate risk has a negative effect on tax avoidance post of COVID-19 pandemic was confirmed in Indonesia. And the third is hypothesis 2A. Inventory intensity has a positive effect on tax avoidance pre-COVID-19 pandemic was confirmed in Indonesia. And the fourth is hypothesis 2B. Inventory intensity has a positive effect on tax avoidance post of COVID-19 pandemic was confirmed in Indonesia. And the last is there is a significant difference between tax avoidance pre and post of COVID-19 pandemic was confirmed in Indonesia. So next we move to chapter 3, research methodology. First is research design. This research is a quantitative approach, where quantitative approach is an approach that uses statistical tools to explain the relationship between variables. And this method is based on the theory of practice to examining the population of an appropriate sample. The sampling technique is commonly random data collection using research instrument and also quantitative or statistical data analysis to test predetermined hypotheses. This research uses the causal comparative approach. This comparative approach research aims to investigate probable causal relationship but not utilizing the experiment. It's carried out by recognizing data from the suspected causative factors as a comparison. Comparative research can be defined as a research that compares the existence of one or more variables in two or different samples at different times. And for population and sample, the population of this research are the companies listed on the Indonesia Stock Exchange 2 quarters pre and post of COVID-19 was confirmed. Sample in this research are the consumer goods sector companies and use purposive sampling, which is a non-probability sampling technique. It means to the sampling technique with a certain criteria. Non-probability sampling means that are not all representative of the population have the opportunity to be elected as the sample. So next, operationalization of research variable. First is dependent variable or Y. In this study is tax avoidance, with the proxy's cash effective tax rate, and the formula is cash tax paid divided by pre-tax income. And for independent variable, or X1, corporate risk, is the formulation EBITDA divided by total asset. And the last is inventory intensity. The formula is total inventory divided by total asset. And for data collecting technique, the data collection method in this study is documentation technique, and also with secondary data from the financial report quarterly or interim on consumer goods sector companies listed on the Indonesia Stock Exchange 2 quarters before and after the confirmation of COVID-19. And data analysis technique in this study using SPSS 25 software. And the technique first is descriptive and statistical analysis, and second classic assumption test consists of normality test, multicollinearity test, autocorrelation, and heteroscedasticity test. And the last is hypothesis testing, consists of regression analysis, different tests for paired sample t-test, coefficient of determination, individual significant test parameter, or t-test, and the last is f-test. And chapter 4, result and discussion. So the description of the research object, the population is consumer goods sector companies listed on Indonesian Stock Exchange. Pre of COVID-19 was confirmed in quarter 3 and also quarter 4, and for post of COVID-19 was confirmed in quarter 2 and also quarter 3. And this is the sample selection criteria, as you can see on the PowerPoint. So the result of the analysis test of the pre of COVID-19 show that cash effective tax rate has average mean 24.79%. So it's still under 25% of tax rate. Meanwhile, the independent corporate risk variable has a minimum value that owned by Mustika Ratu and maximum value owned by multi-bintang company. So at the independent variable inventory intensity has minimum value owned by Sari Roti and also maximum value by Gudang Garam company. And for analysis test result after the confirmation of COVID-19, cash effective tax rate has a minimum value and also maximum value with average 28.94%. This is above the tax rate 22%. And also with the independent corporate risk variable has a minimum value owned by Mustika Ratu and maximum value owned by Tunas Baru Lampung. And for independent variable inventory intensity has a minimum value owned by Sari Roti and maximum value by Gudang Garam company. First, data analysis in pre of COVID-19 condition. First, classical assumption, normality. So based on the table, the residual significant value of the data for regression model is 0.34. This is bigger than 0.5 of the significant level. This shows that the data residual have a normal distribution. And for multicollinearity, this is occur when the VIF value is bigger than 10 and the tolerance value below than 0.1. So this result means that there is no multicollinearity in this regression model. Next, autocorrelation and heteroscedasticity. This is still categorized as classical assumption. For autocorrelation, to test whether autocorrelation occur or not, we use Durbin-Watson test. In this method, this is free from autocorrelation. So it can be seen that Durbin-Watson is 1.24 between 2 and plus 2. This shows that there is no autocorrelation symptom between data based on the time sequence and regression model in the study. And also for heteroscedasticity. A good regression model is homoscedasticity. There is no heteroscedasticity. In this study, to identify the symptom of heteroscedasticity, it can be seen through the point of the certain pattern on the scatter plot. So it can be seen that the regression model in this study doesn't experience heteroscedasticity symptom. And for multiple regression of COVID-19, this regression equation can be interpreted as follows. First, constant value of tax avoidance variable 0.12, where this value show that if all independent variables are constant, so tax avoidance value will experience an increase 0.12. And for corporate risk, this value is 0.15, mean that if it assumes that other independent variables are constant and any change that occur, so CETR will increase by 0.15. And for inventory intensity, if all independent variables are constant and any change that occur in the inventory intensity value, so the CETR will increase by 0.5. And for hypothesis testing, first coefficient of determination, this is from table, can be seen that regression model is 0.36. This show that the independent variable, corporate risk and inventory intensity on dependent variable in this regression model have an effect 36.2% on dependent variable. The remaining 63.8% is influenced by other variable outside the regression model. And for t-test, it can be seen that significant value is 0.069 is greater than 0.05 significant level. This means that x1 doesn't have significant effect, but it still have a positive effect because the regression coefficient is 0.19. Hypothesis 1A in this study was accepted. And for inventory intensity, show that value 0.0, this is meant that below 0.05 significant level. This means that variable x2 has a significant effect on tax avoidance before the COVID-19 pandemic. So has a positive effect because the regression coefficient is 0.33. So hypothesis 2A in this study is accepted. And for f-test, it can be seen that significant value is 0.0. This is below 0.05. They show that independent variable in the study of corporate risk and inventory intensity together have a significant effect on variable y of cash effective tax rate before the COVID-19 pandemic. And second, for data analysis in post of COVID-19 condition, first classical assumption normality, it can be seen that this data for this regression model is 0.057. This is greater than 0.05. So this data is normal. And for multicollinearity, it is show that value 1.012. This is below 10. So show that this is no experience multicollinearity between all independent variable and also dependent variable. And for autocorrelation test, this can be seen that Durbin-Watson has a value 1.45 between -2 and +2. So they show that no autocorrelation symptom at the data. And for the next is heteroscedasticity. This is show that the study doesn't experience heteroscedasticity symptom. For multiple regression at the post of COVID-19, based on the table that you can see in the slide, so the regression equation interpreted as the constant value of tax avoidance is 0.35. So it's meant that this value, if all independent variable are constant, so tax avoidance will experience an increase of 0.35. And for corporate risk, the value is 0.36, means that if all independent variables are constant and any change that occur in corporate risk value, so CETR will decrease 0.36. And for inventory intensity, this value is 0.16, mean that if all variables are constant and also change in occur inventory intensity values, so CETR will decrease by 0.16. And for hypothesis testing, it can be seen on the regression model is 0.056. They show that independent variable, corporate risk, and inventory intensity on dependent variable have an effect of 5.6% on dependent variable. And the other persons influenced by other variable outside the regression model. And for t-test, significant value for corporate risk is 0.03. This means that below 0.05. So X1 has a significant effect on variable Y, but it has a negative effect because the regression coefficient is minus 0.2. So hypothesis 1B in this study was accepted. Conversely, for the significant value inventory intensity is 0.25. This is bigger than 0.05, so it means that X2 doesn't have a significant effect on variable Y. So hypothesis 2B in this study is rejected. And it can be seen at significant value F-test is 0.06, so it bigger than 0.05 significant level. This show that independent variable in the study together have no significant effect on variable Y after the COVID-19 pandemic. And the last test on this study is used paired sample t-test. This test is used to test whether there is a difference between tax avoidance pre-test and post-test the COVID-19 pandemic was confirmed in Indonesia, or used to test the third hypothesis. That hypothesis will test whether there are differences or change in tax avoidance. In this test, the spread variable is grouped into two: tax avoidance before and after the COVID-19 pandemic was confirmed. And the test using paired sample t-test is carried out so that it will be known whether there are changes in tax avoidance that have occurred. From the table, it is used test third hypothesis. It is known that the significant value of 0.055, so it bigger than 0.05 significant level. They show that there is no significant difference between the value of tax avoidance before and after being confirmed by COVID-19. So hypothesis 3 in this study is rejected. Next is discussion of research result. First, the influence of corporate risk on tax avoidance pre and post of COVID-19 was confirmed. So at the pre of COVID-19 was confirmed, the result conclude that corporate risk has a positive but not significant effect for tax avoidance. So hypothesis 1A was accepted. These results mean that most executives in many companies act as a risk taker. Leaders who are risk takers tend to take risky action to increase company profit, so that if company profit increase, executive will receive incentive from shareholder. So therefore, an assumption arises that executive with a risk taker character will be more courageous in doing tax avoidance, so that the company gets higher profit. Adjust to the condition before the confirmation of COVID-19, the result of the research are under the proposed hypothesis stated that many companies had an executive risk-taker character because every company executive was trying to increase company profit by avoiding tax. After all, it could increase the company's cash flow. And for post of COVID-19 was confirmed, this result show that significantly negative for tax avoidance variables, so hypothesis 1b was accepted. Most executives in Indonesian Stock Exchange consumer goods companies have a risk-averse character. Thus, most executives who avoid risk are most focused on decisions that do not result in greater risk. And according to the current condition, after the confirmation of COVID-19, which causes companies to be reluctant to take risks due to the downturn in economic condition, so most executives in general are risk-averse because of course, the executive doesn't want to make a company bankrupt just by taking risk action, especially supported by the instability of the country's economy, so that executives do not want to take dangerous risks. Next, for the influence of inventory intensity on tax avoidance, pre and post of COVID-19 was confirmed. For pre of COVID-19, this study can be concluded that inventory intensity variable has a positive and significant effect, so hypothesis 2A was accepted. Based on the result testing partially, inventory intensity has a positive and significant effect on cash effective tax rate. The more the company inventory, the greater maintenance and storage burden of that inventory. Maintenance and inventory storage expense will later reduce the company's profits, so that tax paid will be reduced. This indicates tax avoidance measure. This is because company that invest in inventory cannot do the same thing when the company has high capital intensity, meaning that depreciation can be used as a deduction from taxable income. So regarding the situation before COVID-19 was confirmed, the inventory intensity at company was running normally as usual, and the company would produce a lot of supplies to meet the demand from customer, so that the high intensity of supplies would support companies to do tax avoidance. For post of COVID-19 was confirmed, the inventory intensity partially has a negative and not significant effect, so hypothesis 2B was rejected. Inventory intensity doesn't have significant effect on cash tax rate, so this show that more or less inventory intensity doesn't fully describe the company as taking tax avoidance action. Regarding the situation after COVID-19 was confirmed, the inventory intensity in most companies is minimized due to low demand from consumer related to community economic condition and decreased income, so that many companies reduce the amount of production and will not use a large investment in inventory asset and incur costs for maintenance. And the last four differences between tax avoidance pre and post of COVID-19 was confirmed based on the per-t sample difference test presented in the table. So the average value of tax avoidance has a significant value more than 0.05. So this shows that there is no significant difference in the average tax avoidance behavior between before and after the confirmation of COVID-19. So this result proved that hypothesis 3 was rejected. In this result, it can be concluded that before the confirmation of COVID-19, there were still many companies that were suspected to commit tax avoidance. Seen from the result of descriptive testing, this is due to low effective cash tax rate of 24.79%. So this is below on the tax rate set by the government of 25%. Meanwhile, in the post of COVID-19 confirmation situation, many companies were suspected of not committing tax avoidance because the average effective tax rate was 28.94%. So it is above the tax rate set by the government 22%. Researchers think that this could be due to the decline in tax rate set by the government in the face of the current economic situation amid the COVID-19 outbreak, so that many companies do not intend to do tax avoidance because it is conditioned by current economic condition. For the analysis of the difference in the average tax avoidance behavior between before and after the confirmation of COVID-19, if it assumes that tax rate is constant, then there is no significant change in tax avoidance between before and after the confirmation of COVID-19. So because the differences is not too far from the t-test result, the effective cash tax rate between before COVID-19 was confirmed is 24.79%, and also after the confirmation is 28.94%, with tax rate set by the government 22% after the confirmation of COVID-19. When we compare to the first situation at pre of COVID-19, so with a tax rate 25%, there are still quite several companies that are indicated to do tax avoidance. And also for the second situation, at the post of COVID-19 was confirmed with a tax rate 22%, where many companies are indicated not to do tax avoidance. So based on the result, the difference between each of two conditions show it was not too significant. And the last is chapter 5. Is about conclusion and suggestion. For conclusion, the company risk variable before the confirmation of COVID-19 have positive but not too significant effect. Meanwhile, after the confirmation of COVID-19, corporate risk had a negative but not significant effect on tax avoidance. And for inventory intensity variable, before the confirmation of COVID-19 has a positive effect on the tax avoidance variable. Meanwhile, after the confirmation of COVID-19, inventory intensity has a negative and not significant effect on tax avoidance. And for dependent variable, show that there is no significant difference in the tax avoidance behavior before and after the confirmation of COVID-19. So the implication in the study indicate that COVID-19 occur is not necessarily a cause or indication for companies to undertake or to do tax avoidance, even though the economic situation was said to have decreased. This result provide information and insight for tax authorities about the company's effort to minimize tax burden, so that action can be taken to close gaps and can be exploited by taxpayer in conducting tax planning, and also about the factor that influence tax avoidance action by companies so that they can strengthen the regulation, and also loopholes for tax avoidance can be suppressed, so can be also used by taxpayer in tax planning. For the limitation and future research, the study only used two variables, inventory intensity and also corporate risk. So it's not include all of the factors that affect tax avoidance. And also it's only used one sector of Indonesian Stock Exchange company. This is consumer goods sector. So maybe other sectors can be reflect the tax avoidance. And for time horizon of the study is limited because only 2 quarters before and after the confirmation of COVID-19. So I think to the future research, it can be extend or take a long time, maybe about 5 years or more. So that's all of my thesis presentation. Thank you so much for your attention and watching this video. Assalamualaikum warahmatullahi wabarakatuh.